Majority of the Nifty 50 stocks are lower, but there is nothing very large in terms of a cut. Rohit Srivastava is joining us, fund manager at Sharekhan. Rohit, always a pleasure to have you with us here. Let me first wish you a happy 2014 once again.
Thanks.
Is this the start of a bigger fall, Rohit?
I think so. My view is that we have been distributing, I would call it a distribution for the last couple of months, and essentially what you've seen is the Nifty gain around 3% from the high that we made in September. Whereas the mid-cap indices are up almost 17 to 18% in the same time frame. So essentially what you've got is a broad market rally in a lot of the small stocks that had been battered down for the last 9 months. But that's about it. I don't think this is the start of a bull run as is being anticipated by many. I don't think there's enough evidence, and I would really like to see that. I would think that if there is any rebound in growth, it would be a smaller cycle in the overall slowing down process that we are witnessing. So it's a very contrary view to what is going on till we have evidence. So yes, I think we are at the start of a sell-off, and which might rather than just be local, might be getting global too.
So let's just define the sell-off and how large can it get, Rohit?
There are a couple of degrees at which one has to think, because the market did run up so smartly from an extreme negative sentiment that we had in August. A lot of people are willing to believe that all you'll get is a correction. So we start with the thought of a correction. A correction could be anywhere between 5,900 to 5,600. So it's a pretty wide range to start with. I think even up to 5,600, you could call it simply a retracement of the rise that you saw from the August lows. But my sense is that you're at the end of also an 8-quarter rally. Now if you look at the bear market in 2008, it was around 4 quarters, then you had an 8-quarter recovery, then again in 2011-12 you had a 4-quarter decline, and now you're at the end of another 8-quarter period from the low that we made in December 2011, which has ended just this month and this quarter. So we've completed that much in terms of time, and during which you're seeing fewer and fewer stocks participate on the upside. So my sense is once you've completed across sectors distribution, which I think is done in most, including banking, and almost looks complete in the auto sector. The only two outstanding sectors are probably tech and pharmaceuticals. Pharma might remain the only defensive area for some time, but I think once that is done, once you've seen even a top in tech, I think then most of it is done as far as the distribution is concerned, and then it would be more on the downside. So then you would have to start thinking of why the market can't really go below the 5,100 level that we've seen in August.
Okay, so right now you're saying that we could retrace to about 5,600, which would be a retracement of the rally that we saw from August, all the way to whatever 6,400 in the Nifty. But it's possible we retest the August absolute close as well, once sectors like tech, etc. top out, and they're pretty close to doing that. That's what you're saying?
That's right. That's exactly what I'm saying. So you need to keep the risk in mind that you can get a deeper sell-off and not just a correction to 5,600. And rather I would prepare for it rather than think, okay, let it come down and then we will see. So I'd rather be prepared for a deeper sell-off. Not just because the markets have run up 8 quarters here, but also if you look around the world, what we've seen is, I think India was probably the only Asian market that managed to give such a strong recovery. Most of the emerging markets essentially did not retrace or go up more than 61% of the fall that we saw in the first 9 months of 2013. Whether you look at Thailand, Jakarta, you go to even Mexico, Brazil, none of them have really recovered. Even China, the Shanghai index has not really recovered. There's been a lot of news around China, whether there's rebound on growth or not, but their markets themselves have really not been able to manage a rally, and they are again selling off in the last couple of days on weaker data. So you have weakness across the board. I think in that sense, over the last quarter, India was probably one of the best performing emerging markets, and that might just be coming to an end, as most of these markets, if you just see the last 2-3 days, have started falling off again.
So essentially, your reasoning behind markets correcting is not just mean reversion, right? Because the argument is, well, IT, pharma, consumer staples, etc. did well in 2012. Can they do well for another year? Maybe the answer is no. They'll come back to mean. But that's not. That is also a factor, but that's not the basic important argument you're making, right? You said 8 quarters they've gone up, and I mean that's the reason, but that's not the only reason.
That's right. That's not the only reason. I'm not thinking mean reversion. I think people looking at that, I mean, one of the numbers which even our own research desk floats is the forward PE. Now, when we look at the market technically, we like to look at the actual PE, the current PE which is reported by the exchanges. And the reason for that is just to keep biases out of the numbers. You can get pretty biased. So those, and the variation, I think, between these two numbers has only increased in the last couple of years. It would be 2-3%. Now it's almost 6-7% between what these two groups are reporting. One is at 19 more than 19 times, and the other one is now somewhere around 13 times. So you have a 7-point difference between the two, and both cannot really be right. So somewhere, if I look at standalone,
would you say market generally follows the forward PE, trades on the forward PE? I mean sectors like IT, etc. Right, pharma, IT. I mean, if you look at the reported numbers, then I think not IT maybe, but pharma, for example, consumers most definitely are trading at much higher valuations than they usually have traded for over the last many years. And bulls argue that fiscal, with forward PE, the difficulty with sectors like IT is, since you're talking about a strong demand revival in the US, which is the biggest market, the reason for people saying, well, they're overvalued, etc., is because there is no clarity on what the strength of the comeback and growth in fiscal 15. And now the street will look at fiscal 15 numbers.
Maybe I'm thinking far more macro than micro, and it's possible, that they continue to do well for some time in terms of actual numbers. But there are a lot of factors moving here. We are looking at currency markets, but when we look at currencies, we only think about, our exports becoming cheaper, and therefore we doing more business. What we don't see is that what globalization has really meant, and what it might mean if you get a strong dollar scenario over, say, a 1-year period. It will actually mean something very different for the US. You would have competition first from various other currency markets as well. The risk really right now is that you end up in a global currency war, something that's a hanging sword. Most are not willing to call it that as yet, but what has happened with the Japanese currency devaluations is that you're pushing most currencies to weaken against the dollar. Now, at some point of time, the US itself would has played essentially the globalization card very well. I think that's where we've stayed behind the curve, because if we used it well, probably we could be at advantage India based on what globalization really meant, and that has not happened. So we are really thinking that because the US is doing well today, we will continue to do more business. We're not really thinking about the amount of that we can actually lose business to someone else, and maybe the US itself.
So this ties in. I had 3 questions, 3 global macro-ish type of questions, right? Since you're saying you're thinking macro-ish, right? So the 3 questions I have, and I wanted to do the impossible and give me a 2-minute answer to this. Will monetary policy, if you agree that, and you've been saying for a while that the big driver, and many have sort of come around to the view that the biggest driver for markets worldwide is monetary policy, and the unconventional monetary policy being followed by many global central banks. My question is, first is, will monetary policy in 2014 be simply be more of the same, or will it be different? Second question is, will US growth improve substantially? Markets there are trading very strong on the expectation that growth is coming back very strongly, and everybody's forgotten about Europe. Will we see a Eurozone-led contagion, or you think everything is under control? The institutional mechanism, etc., is there now, unlike in 2011-12 when we did see a contagion because of what was happening there. What's your sense, Rohit?
My sense as far as Europe is concerned, from what I've been reading, is that risks around the Eurozone are likely to show up again in the next year. Will monetary policy remain the same? Yes, it will, because when these risks show up, they're probably going to apply the same medicine that they've done in the past. What you really want to see is how it will work this time around, because you've already got expanded balance sheets of various reserve banks around the world. So how it's going to impact bond markets becomes another question, and you've seen bond yields jumping up all over again, including the US, which was not which was actually seeing falling yields for a very long period of time. So you have a lot of the key factors, or rather the numbers changing in terms of yields and currencies. You have the same medicine being applied, but will these markets respond in the same way to the same medicine is what we are really going to be looking at.
But when I said the central bank and policies, I was referring to large central banks, because in US we are talking about the taper, but Japan, they're talking about doubling down on their efforts, and Europe, of course, they've not used some of the facilities like LTRO, etc. for a while, but they're there.
Exactly. So which is why I said that while we are not calling it that, you could be looking at a currency war which has started from Japan. It goes to Europe when they really need to push for growth, and the rest of the emerging markets are already seeing weakening currencies. Whether we call it a currency war or we just call it a currency adjustment is just a matter of terminology.
Got that. Rohit, thanks very much for dropping by. Great to have you with us here. Appreciate your time here as always. Thank you. Rohit Srivastava at Sharekhan. Let's take a quick break. We're back in 2.